Hello, everyone, ladies and gentlemen, traders from all over the world. Myself and Admirals, we would like to welcome you to this webinar. It's a privilege and honor, actually, today to present you Mr. Steve Nison, the gentleman who is, I would say, in the best way, responsible for our knowledge today about candlestick patterns that we trade for so many years in all the markets, and we have enormous success, of course, taking consideration the losses as well. But the most important thing is that we have this privilege today to hear from the man itself how is the best possible way to read the chart using the candles, to trade them, and of course, how to avoid using the candles. And I remember earlier we had a conversation with Steven. He mentioned that unfortunately nowadays the traders, they just they don't use the candlesticks the way they supposed to use them. And I believe today it's going to be such a great webinar, guys. You're going to learn so many things. And well, Steve, again, it's a privilege and honor to have you here.
Thank you. No pressure. Can you let me share the screen?
Yes.
Okay.
Sure.
All right. Yeah, I have some slides we'll go through, and Theo will just ask me questions as we go through it. It still says disabled.
Yep. So try now, maybe.
Oops. We are good. Thank you. Okay.
Okay, great.
Good.
Thank you, Steve.
Perfect. Thank you. Okay. So yeah, just so here, you know, Theo was nice enough to give you some of my background. But my books, which is really cool. Many of you probably have seen my book in your languages. My books have been translated to 21 languages. So before we begin, let me just very quickly, I'm not going to read this unless you want me to, Theo. Take an hour, and now that'll take an hour.
No, that's
all right.
Okay.
So just essentially, there's a risk of loss of trading in any market in any time frame. So if you have nothing to do with the rest of your life, you can go to this link here and just read this whole thing. So some of the benefits of the candles, and I'm going to go through this part very quickly because I know I'm sure 90% of you understand the basics of candles, but it's really important that we get a foundation for everybody. The candles are really easy to understand. One of the major benefits of candles, and I'm going to go over some misuses of candles about calling the early reversals, is they very often give you turning signals ahead of traditional Western technical tools. And as I'll mention later, it doesn't mean you don't use Western tools, but you should add candles to. We'll go through that later. Safety first, and this is something that he had mentioned in the introduction. Risk, knowing what not to do, and you're going to see there's potentially times there are candlestick signals that you should ignore. Not every candlestick signal should be used to initiate a trade. We'll look at the power of Eastern and Western techniques later. And I know most of you trade Forex. Many of you may trade intraday. Candlesticks work in all markets and all time frames. My focus is mainly swing charts. So I'll look at daily. Sometimes to get early indications of reversals, I'll look at intraday. But no matter what your time frame is, they should work well. Some of you may have more experience than me in intraday trading because I'm not an intraday trader. But everything I'll be talking about here is applicable in all markets in all time frames. So again, I just want to go through this quickly. And this, just shows you all markets and all time frames. So just very quickly, the real body is the relationship between the opening and closing. If the close is higher than the opening, it's an empty or green real body. The top of the upper line is the upper shadow, the high of the session, low of the session. The opposite with a red real body. I know I'm going through this very quickly. And so a doji is when the opening and closing are the same. And the reason the Japanese, they used to use bar charts for my research. I had about 14 books translated from Japanese to English. And they used to use bar charts up until about 1900 or 1910. And then they switched over to candlestick charts. And the reason for that is, although it's the same data as a bar chart, you get so much more visual information about who's winning the bull between the bulls and the bears. And that's why, I mean, if you think about it, if it wasn't for me, everybody in the Western America would still be using bar charts. And the reason all the charts are now in candles is it shows not only the price, but the force behind the move. So just very quickly, okay, who's in control here? Obviously, the bulls. The market opened here and closed here. Now that's amazing. It's the same data as a bar chart. You could make a bar chart, and I guess you can mentally convert it to a candle chart, but why bother? So you can see the bulls are in charge, the bears are in charge. Now with the opening and closing, okay, who's in charge here? Nope, right, it's an equilibrium. Now, let me give you a heads up, one of the misuses of candles. People will see a doji, and in fact, in my book, I had a Japanese proverb in the chapter on doji, and the proverb was danger lies ahead. And the problem, I should say, not a problem, but people think there's a doji and that means you should immediately sell, and that is not the case. And we're going to look at examples of this later. A doji, and you can write this down, a doji means there's a balance between the bulls and the bears. So if we have a rally, and I'll show some charts later. And by the way, most of my charts are not Forex. I just, I do trade a little bit of Forex, but whatever I show you there is applicable in the Forex market. And we'll have a link for a way to get more information about candles and Forex at the end of the session. So just think of this as, if the market's moving up, there's an equilibrium between the bulls and the bears, and it could continue still moving up. But one of the ways I trade, if I see a doji, and we'll look at this later, especially if it's confirming resistance, it's really hard to short in equities. So when I talk about selling, I'll talk about maybe moving up protective stops, moving, locking in some profits. In Forex, it's great. I mean, both options in Forex, very easy to short. So you have a lot of advantages that equity traders don't have. You're going to be able to sell as easily as buy. We know markets a lot of times move down a lot faster than they move up. So bullish engulfing pattern, and many of you may be familiar with this. The white, the green wrapping around the red, and it has to be real body wrap around real body, okay? And visually, again, the power of the candles, the bulls are taking over from the bears. Bearish engulfing pattern, a red real body, or depending on your charting system, black wrapping around a green, or depending on your charting system, white. And the bears are taking over here. Now, notice the arrows here. Very important, another common misuse. A bullish engulfing pattern. He feels laughing.
Yeah, I'm waiting, yes, for that.
Yeah. A bullish engulfing pattern comes after a downtrend. All right, it's a bottom reversal signal, even if it's a short-term downtrend. And I can't tell you how many times we have students in 85 countries, so from around the world. They see this bullish engulfing pattern during a rally, and they'll buy only to have the market go down. Yes, the bulls are taking over from the bears, but this is really designed as a bottom reversal. So it's only a true with a bullish engulfing pattern. You need two criteria. One, the combination of lines, green real body wrapping around red real body. Second criterion, downtrend, and the opposite with a bearish engulfing pattern. Okay?
Steve, at this point, can I ask
interrupt
something,
anytime?
please?
Yeah, interrupt.
So what happened, especially I see it from traders when we do live webinars here at Admirals in the morning, they ask often, the bullish engulfing, for example, shouldn't be wrapped the whole high and low of the previous candle, or just the body. And at some cases, many lucrative trades missed by traders just
Mhm.
because they were waiting to see the engulfing candle to totally engulf from the high to the low of the previous candle. Can you please clarify?
Yeah, and I got a really cool trick to tell your students. Okay, so first of all, right, it's only real body wrap around real body. All right.
Great.
Secondly, if this is a doji, it's also the Japanese also consider a bullish engulfing pattern. But
Mhm.
there's a little trick that I'll do sometimes. So, like you said, Theo, you have to wait. Remember, the candle needs an open, high, low, and close. So you
Yep.
don't have an official bullish engulfing pattern until it closes. All right. Depending on your risk tolerance, what you could do is I'm talking from a daily chart, and you could scale down. Let's make it a 60-minute chart. All right.
Yep.
So let's say it's a 60-minute chart, and during the 60-minute period, let's say you're 45 minutes into it or half an hour, it's potentially forming a bullish engulfing pattern, right? You could think about buying very lightly,
Mhm.
although it's not a close. And then if the market, as it gets to the close of that hour, if it gets under, like say here, or it's not going to form a green candle, you exit the trade. If it works out well, because I've seen this many times, if you get in early, by the end of the session, the bullish engulfing pattern could be a really big green
Yes.
real body. So that's kind of a little trick that I'll do sometimes, depending on your risk tolerance. Getting in before the close, a little
Yep.
riskier, but as long
Yep.
as you have a good stop and a good risk reward, that's kind of a trick you can do.
So a strategy must be applied to the letter, right? So we cannot deviate. Traders cannot deviate from their strategy. Okay, didn't close bullish engulfing. Maybe it's a gravitstone or it's a shooting start, inverse hammer, whatever at support. They're trying to give some excuses
Mhm.
for a reason to stay in the trade, regardless if the rules say, hey, that's not a candlestick pattern that shows potentially reversal. So better scratch the trade and just move on.
Right. What I find, because, obviously a lot of trading is emotional and psychological, the best time to place a stop is when you do the trade. So in other words,
Absolutely.
because that's when you're very objective. When you're initiating a trade, you're in control. Once you're in the trade, the market is kind of in control, and you start rationalizing. It's human nature. We don't want to admit we're wrong. So what I'll do is if I did that trade, if I say it's now a chart at 45 minutes in, I would automatically have a protective stop under the low here. And that's it.
Yep.
It's done. I don't have to worry about it. Some traders are really good about saying, okay, I'm wrong, I'm out. But unfortunately, it's hard because you always try to rationalize.
Yeah. So we put the stops when we initiate the trade. And of course, that's not negotiable.
Right. Yeah. When I was researching the candles, I was working for, I think, Merrill Lynch back in the 80s. And I was giving trade recommendations to the brokers. I was doing futures back then, and they tracked our profit and loss. And I didn't let the brokers know I was doing candles because I was still doing research. And out of the 20 traders, I had the best P&L, but I'm not saying that to brag. I also had more losses than wins.
Yeah.
And that's because I knew how to set stops. So, okay, so here's a classic bullish engulfing pattern. Now, this is in Bitcoin. It just took off. A candle signal doesn't mean the market's going to rally like this. Candles, and if we have time later, I'll mention it, but candles don't give price targets. All right, that's why it's important to add Western technicals. But this was absolutely classic because it was, and very often, many of the candlestick signals become support or resistance. So the lower the bullish engulfing pattern, based on the close, potentially becomes support.
Yep.
Right? And here you have a hammer. Okay. So this is it's confirming a support area. Here we had a classic shooting star. Now, see, here's a case in point. There's a shooting star. In theory, it becomes resistance, but it doesn't mean the market's not going to get above that. So especially there's a gap, a rising window. That's actually a bullish signal here. So, but here, this is a classic bullish engulfing pattern. I'll go through this quickly. Okay, here's a proverb. I like throwing Japanese proverbs in. It takes the clap of two hands to make a sound. And with that in mind, we have something called the trading triad. Triad is a Latin word for three. So we focus on candle charting techniques. it's really important also to add Western techniques. I have my favorites. I look at horizontal support or resistance. Your traders probably know the best that works in their markets. Some may like stochastics. I know Fibonacci is really big in Forex. Whatever you're comfortable with, stay with it, because if you have a combination of a candlestick signal and a Western signal, you've greatly enhanced the likelihood of a return. So I have some trading principles, and what I suggest is analyze the candle signal at support or resistance. Okay, however you define it, you have a moving average. This is my work desk back in the late 80s, early 90s. These are just some of the Japanese books here that I had translated. This middle portion, and you'll see where I'm going with this middle portion here. These are all the English translations of the Japanese books. That's why it took me a year to. It was an absolute fortune. I paid for everything, and it took me a year to organize all the translations. I was lucky. I found an American who was also a trader who spoke Japanese. I told him to buy every book he could on candlesticks. So, but anyway, the reason I wanted to show you this is here's an example of one of the books, and each of the candlestick books, half were on candlesticks, but the other half was on Western technical indicators.
Very
So
interesting.
for generations, Japanese have been using that. So as great as candlesticks are, I strongly advise adding Western technical tools to your.
Awesome. Steve, can I just take a minute before we proceed furthermore? And it will be really interesting for the audience to, they are wondering maybe, how did you start your career, and how did you got into the field of trading? I mean, just at this point, it will be really interesting to know a few things about yourself.
Okay, so I started my first job after school, and you'll see where I'm leading into on this. So my first job, I worked at a commodity consulting firm, and I would help. I wasn't a technical analyst, and so I'd help write reports about. And we had clients like who bought copper or who bought cotton to make shirts. So the owners of the company would tell them when to buy for their supply. And so we'd write these really big reports about like copper and Zaire, whatever it is. But what was interesting, whenever they were on the phone with clients, they had a chart book. Making all the recommendations on charts. This is back in the 70s, and they didn't want to tell their clients they were using technicals. So I got involved with technicals. I said, there must be something to it. Anyway, so I became a technical analyst. I worked at E.F. Hutton and Merrill Lynch and things like that. And when I think it was Merrill, so down the hall, there was a Japanese broker, and I went into her office, and she had a chart book, this voluminous chart book, and it was in Japanese because she dealt with Japanese clients. She was Japanese. And I said, what's this? Oh, she said, these are candlestick charts. I said, what? What are those? And so she said, we've been using this 100 years. I said, what? So I got really interested. I found a pamphlet in the Market Technicians Association is a group here in the States, and it's worldwide, is the Nippon Technical Analysts Association and so forth. And there was a little binder in English, a couple of pages on candlesticks. And so that really got me interested. So I did a 2-page article in Futures magazine, and it got me really popular. Some of the charting services started to make candles. And then like I said, I found an American who happened to be going to Japan, who was a trader. And I said, this stuff really looks fascinating. And it could help me with my trading and my advisory services and so forth, my advisors, my trade recommendations to the brokers. So I told him buy every book he could. He translated them. Like I said, it took him about a year to do that, a year for me to do it. And then I wrote my book, and it's still, And it was fun writing the book because, like I said, at the beginning of each chapter, I have a Japanese proverb. And the challenge I had with the candlesticks is a lot of it was related. The Japanese do everything not everything, but a lot of stuff by metaphor and analogy. So they would make comments like, trade like the 3 monkeys. What the hell does that mean? So I had to research. I had to learn about Japanese history, about the military and all that. Essentially what the 3 monkeys meant, I found out they were the first. I don't know if it's the same in Europe, but we have something here where see no evil, speak no evil, and talk no evil.
Yes. Yes.
Yeah. Okay. So that was actually on top of Buddhist temples. And
Yes.
what the author in this book was referring to is trade like that. Just kind of look at the charts. Don't tell anybody what you think. Don't listen to what other people are saying. And so forth.
Wow.
So yeah, this way it took me forever to do, but I like challenges. And so I threw a lot of that into the books also. So yeah. So yeah.
Awesome. Thank you so much for sharing
yeah.
that. It's really interesting.
Yeah. Yeah. So can I move on, or yeah, anything else?
Yes. Yes, please. Yes.
Okay. So here's a combination. I said my favorite indicators are just horizontal support or resistance. Maybe I'll look at a couple of moving averages, Bollinger Bands, see if it's over. But I really like the old KISS principle: keep it simple, stupid. So here, this is not a bullish engulfing pattern, but it's a piercing pattern, and many candle signals can be used as support or resistance. So right near that support area. Now notice right here, we had a bullish engulfing pattern right near support. All right. And as long as we're on here, let me show you a little nuance. Now we said engulfing patterns potential support. So let me ask the audience, and again, don't answer, just think of this verbally. If you bought in this bullish engulfing pattern, would you set your stop under the low of the bullish engulfing pattern? Yes or no?
Come on, guys. That's a very, very nice question. Let's wait for some
you'll tell me
people to write on the chat. Guys,
okay.
did you understand the question Steve asked?
So here, there's a bullish engulfing pattern here. Okay, if you bought on the bullish, now remember, bullish engulfing pattern is potential support. So would you have a protective, if you bought, would you have a protective stop under, this low here?
You mean the low of the bullish engulfing or the low of the red candle?
That's what it is. Yeah, that's the answer. Wouldn't it be wouldn't it be silly? I mean, or upsetting? Yes, the bullish, and there's a lot of.
1 second, Steve. We have lots and lots of comments coming in.
Okay, well, we'll have to do it later because we have a lot of stuff to go through. So I'm going to give you the answer. So anyway, yeah, too bad we don't have more time. I could do Q&A like this on every chart. So anyway,
I will write this slide down and we're going to come back for the Q&A, okay?
Right.
We are on slide 16.
The low of the bullish engulfing pattern. So let's imagine you put a stop under the low of the bullish engulfing pattern. The market gets down to here. Everybody can see the arrow, right? The arrow? You can see the arrow, Theo?
Yes, I can. Okay, I think everyone can see the arrow.
The answer is I would have it under the low here. Because it's so close. If you had the bullish engulfing pattern here and the low down here, that's a separate thing. But often I'll make a support zone like this. All right. So moving up, we have obviously a bearish engulfing pattern. The high of the bearish engulfing pattern.
Sorry, Steve. Sorry, Steve, to interrupt you. I would like just, because you revealed the answer, obviously, there are few people they mentioned below the support line. But most of the people they mentioned below of the red candle, the first one, not the piercing.
Good. You got an intelligent group there.
Exactly. But nobody said below the green bullish engulfing candle. Perfect. So it's perfect.
Right. And that's kind of the point I wanted to get across is that the subjectivity, if there's something really close to it, I would, make it a zone. Here's a bearish engulfing pattern. The market got to the resistance with the doji. Right now,
that's an interesting one. We see the lot in forex on daily charts as well, and it's something traders they ask: isn't a high probability trade to take this double top with this doji, regardless if maybe we don't have that gap in forex.
And this is not a real. By the way, this is not a real. There's a gap between the real bodies, but a true gap. What the Japanese call a window is if the real bodies don't touch, if the low and the high, it's the same as a Western here. Like this is a true gap. The low here is above the high here. So a lot of people will think a gap or a window means the real bodies don't touch. It means none of the candle can overlap. So you see the high here overlapping here. There is a gap between the close here and the open here. You're not going to get that much in forex. You're not going to have
only on Mondays we get it sometimes.
On Mondays, right? Yes. Right. That's right. Except for Monday. So now another question is, I don't want to, I won't go to a question that takes too long, but here we have a doji confirming resistance. Now, does a trader, let's say it's Forex, would they want to be short here? And depends on your comfort level. We have a candle signal confirming, actually a bearish signal here, resistance. Okay, so what I personally would do is nibble from the short side. But what I would say to myself, although this is a doji, this is the highest close since the rally of the bullish engulfing pattern. So some traders may want to say, yes, there's a doji, the market is hesitating, but this is the highest move since the bullish engulfing pattern. They may want to wait until the next session when the market, if the market moves down. The plus of that, it gives you extra confirmation that the market is turning. The negative of that is you have a worse risk reward because you're selling at a lower level.
Exactly.
So there's no correct, it depends on your risk orientation. So maybe you would nibble a little bit on the short side here and then add to a short position as the market moves down. So it all depends.
This is very important for traders, especially I find many names here that they are familiar because they join me on the live trading in the morning, and many times they ask, okay, we have this double top here, we are in an uptrend, but we have this reversal candles, doji reversal candle. As you mentioned, it's not by the book a reversal. The doji is just balance between buyer and seller, but you gave a great answer to the traders that if you want to take that trade to the downside, better maybe to risk a little bit, not a full risk on that trade, and then you can add on if there is a confirmation.
Mm-hmm. Right. And something else, you know, I just saw this in the chart. So a lot of times, this is a box, the support here. We have a support zone here and high. So this is a lateral trading range. So sometimes when you get a reversal, your target is the bottom end of the box range, which would be the bullish engulfing pattern. So, but let's say you're flat. And on this session here, I would view this as a hammer, the bottom reversal signal. It's confirming support, right?
Yes.
So I'd think about buying a little bit. Again, it's still a lower low, lower high, lower close. I'd think about buying. But what would say you were wrong on the next session? Market closed under support. And,
exactly.
Right. And you have to pull the trigger. So what I would suggest doing is when you buy this hammer, and as long as it's around the same low here, you immediately put a protective stop, especially on the close under here, because we all rationalize, hey, let's see what happens the next session. Let's see what happens the next session. And
exactly.
So this would have saved you a lot of financial pain. So protective stops is really what it's all about.
And Steve, before we start, I saw many questions that came, and they were asking, please tell us about the stop losses, where you put stop losses with Candlestick. And it's great that you mentioned, and I'm sure everybody understands. You explain so clearly, so everyone understands perfect, and that's awesome.
Yeah. What I'll normally do is, if you're willing to wait to a close, I do a close under the support area, but it'll depend on the risk reward. So if I'm buying here, let's say my target, I don't have time to get into this, but I like change of polarity. Prior support becomes resistance. So my target might be, my minimum target would be here. My more liberal target would be up here. So what ideally we could wait for a close, but if you wait for a close, the market could be all the way down here.
Yes.
So what I'll do is it depends on the risk reward. So I'm making up numbers here. Let's say I'm looking to make 50 pips. Okay.
Yep.
And so that means I like a 1 to 2 risk reward. I'll be willing to risk maybe 25 pips. All right. Intra-session. And that would be my protective stop. I base it on risk reward a lot of times.
Yes. And I like the risk reward. It's something you mention a lot in your book all the time. Basically, I read the 2 books, Beyond Candlesticks and the Candlestick Patterns, and I was very surprised. I was expecting to read only about candles, candlestick lines, combination, and all this stuff, but I was amazed by the emphasis you give on the reward to risk. And at many occasions, you mentioned that maybe there is a great textbook trade to take, but the risk reward is not favorable to maybe initiate the trade. And I'm sure it's something you're going to walk us through, right?
Right. Sorry, I had to tell my, I don't want to say her name. She was reminding me to do something. So I had to tell her, shut up.
That's okay.
So here's an example. I will look at risk reward a little later, but very, we'll look at a risk reward because it's really, really important. You can have a perfect candlestick signal. Analyze the candle signal at support or resistance. So there's a bullish engulfing pattern, but really the support area is here. But what I like doing is you can see the real bodies, what's happening with the real bodies in the downside momentum. See, the real bodies are getting smaller and smaller. So that means the bears are losing control. It's still a downtrend, but what's nice about this is as the market got to support, the bears were losing momentum or the bulls came in very aggressively. And then you got some bullish confirmation with a hammer. So
where should you initiate a trade at the first green candle after the bearish lose momentum? Not there.
Right here.
No, on the right. Where is the arrow pointing?
No, I probably wouldn't. And let me see if I talk about this later. But anyway, there's a gap here. This is called a falling window. And in the West, we don't use gaps as support or resistance. And the Japanese use windows, gaps as support or resistance. And so if I bought it here, my target would be here. I wouldn't do the trade.
Yeah, and sorry. Now I'm talking about after the arrow.
This?
Yes, that one, the first one.
No, I'd wait probably for the hammer.
Yes.
Right, because there's no real bottom reversal signal here.
Exactly.
It's showing us the momentum's drying. Again, it depends on if you're aggressive. You may want to start nibbling on the long side here. It's a great risk reward because you're buying it here or here, and your stop is under here, and my target would be up here.
Yes.
So you might, but for those who are a little bit more conservative like me, I'd wait for the hammer. It's still a good risk reward. Stop is here and your target is here, but there's no exact right answer. Some of you may say, yes, I'm going to nibble here. I don't mind being a little bit more aggressive. And then you could add, you see the hammer, you could add to a long position. Okay. I had these cartoons made up. I found a cartoon I see was great. So I can tell you how far it is, but I can't tell you how far it is, but I do know it's that way. So candles don't give targets. So one of my favorite Western measuring techniques are boxed ranges. I like them because here, for example, the bottom end of a box, we have a hammer. So our target is the top end of the box. And what I like is price target. So when you're in the box range and you break out, you have a target to the higher end of the box. A little FYI, once again, I don't have a slide on this, but I like using a multi-tested resistance area. I swing it over. I call it change of polarity. I don't know. I'm sure it's a Western technique, but this old resistance, very often, if you mentally swing it over, becomes support. See that?
Yes.
Once you close above it, it becomes a potential support area. So if you buy on a breakout of a box range, I would have a protective stop under this horizontal line. Okay. The opposite, I love this expression, falling off the roof. This happens to be the Nifty. We have a lot of Indian clients, and so we follow that for them. There's a weekly, and a falling off the roof is a false breakout. Essentially, we recognize as a shooting star. But what's cool about this is how quickly we met a target. So falling off the roof is the market gets above resistance. The reason Japanese call it falling off the roof is they have an expression, let him climb the roof and then take away the ladder. So look out below. So anyway, the market gets above resistance, but can't hold above it. All right. As soon as it gets below here, you could actually think of selling, keep a protected stop here. And what's nice about this is the target is the most recent low, which would be here. It doesn't mean that's going to be the first support area. But what's cool about the Nifty is look how quickly it reached the target. I mean, it doesn't always happen that way. But you can see it's not just the candles I use, a lot of nuances. And like I said, we have educational resources that go through all this a little bit later on. Another, of course, Japanese proverb, look on the outside to know what's inside. Okay, knowing how to use current candles correctly. All right. The really sad part is these are my parents, but we won't go into that.
Okay.
So I went over some of the misuses, but Admiral Theo asked me to kind of go over misuses and more misuses. So I want to really go through
yes,
that.
please. Yeah. And I have one question that I see a lot of
where my parents live. Do you want to ask where they live?
No. I have a question in regards to the previous slide, actually. And it was really an example here. It was an example happened, I think out of memory, it was last month. And it was on daily charts with the Japanese yen pair. And if I'm correct, the obvious one was the Australian dollar. Yes, Australian dollar against Japanese yen. Daily chart. A long upper tail rejection candle like this one here, but not at resistance, somewhere else at support. Unfortunately, many traders, they took the trade. And that's something else I would like you to put some emphasis on, if you don't mind.
Yeah, I'm not sure. What's the question?
So this, let's say, long tail upper candle or shooting star, but on support, not at resistance, on support.
Okay, on support.
Yeah. Not even break below, not false break the support, nothing.
It just held support. Okay. So the question is, how would I view it?
Yes.
Okay. So
would you sell it because it's a very obvious?
No. Why sell at support?
Exactly. So
right.
That's something.
The upper shadow is a negative, right? Because at some point the market got up there. So it shows that the market cannot hold the higher highs. But why? Well, I shouldn't say why sell at support. Depending on your risk tolerance or trading style. If you sell it at support and you're right, you're getting in earlier. But it's a higher risk trade. It's a high risk trade because you're selling at support.
Yeah. So high risk trade means low probability trade.
Right.
Okay.
Right. Yeah. Okay. So here we have the doji. Not all doji are equal. So here we have a doji. It's in the middle of the box range. A doji is neutral. A box range is neutral. I wouldn't do anything with that doji. If you sell this doji, I didn't. However, if it's here, it's a whole different scenario. Two doji, what you would do with them is completely different. I call this candles in context. Look at the overall technical picture. Look at where the candlestick signal emerged. We looked at east and west. If the candlestick signal confirms a western signal, that's a higher potential probability of a trade. Okay. Yeah. We talked very briefly about windows, but the next slide, I'll show you an example of why you want to have this. A rising wind is a potential support zone. And you can see the market gets under it, but as long as it closes above it, the support holds. So the reason I wanted to show you this, the Japanese will say correction stop at the window. So here we have, this is called a gravestone doji. It's actually like a shooting star, but it's a doji. The Japanese call it a gravestone doji. Again, just great ways of phrasing things. They say it represents a tombstone of the bulls who died defending their territory. Right?
Okay, that's interesting. I remember that from your book, by the way. It's in your book. I remember it. Yeah,
it's interesting. The press picked up on the book. They said it was great. Well, they really got interested in the proverbs and all these great expressions, and so that's what piqued their interest. Anyway, so gravestone doji sounds really, really ominous, right? Oh my goodness! But candles in context. What happened on that day of the session? There's a little hint here, right? So this is a rising window. So if you're selling it there, you're actually selling, and this is really interesting. This is like your question, Theo, long upper shadow at support.
Yes,
right.
Yes, funny. Exactly.
It's not a downtrend though. So here we had a classic. This is a great bullish engulfing panel. We'd be buying here because it's confirming support and looks like a good risk reward also. So
yes.
But over here, this is exactly it. Why sell at support? So what I would say, again, depends on, your trading style. If you want to sell it here and hoping it closes under the bottom of the window, the bottom of the gap, the window is the major support. And look what happened. So you go online, you say, I see on the internet, there's a gravestone doji. Oh my goodness, sounds really ominous. I'm going to sell it here. You're looking at candles in isolation. And that's why I had the proverb, it takes the clap of two hands to make a sound.
Yes.
You need the candles and within the market context.
So traders, just make sure you get this. I don't know how more to emphasize Steve himself saying that we don't look candles in isolation. We put it within a context.
Right, and that's what that's what our education is all about. We have sessions that are hours and hours.
Exactly.
Bits, but
and
so much.
Steve, what do you mean, please? Someone asked, can you define the market context?
Market context, meaning where a candlestick signal appears within the market context. So let's look at this.
Yes.
Here's a bullish engulfing pattern, right? Now let's look at this within the market context. What happened before this bullish engulfing pattern? Support area, right? I would view this more positively than let's imagine we had a bullish engulfing pattern that, let's forget about this over here, that did not confirm support. All right. And this was really a nice one because it confirmed the support here and here. But if I saw a bullish engulfing pattern confirming support, I'd be more aggressive on it. Let's imagine there's a bullish engulfing pattern, but right above this, let's say this bullish engulfing pattern, say there was a falling window right over here. Let's imagine there was a gap down. All right. And so the gap is over here. There's a falling window. All right. And you have a bullish engulfing pattern. It's kind of the flip of this. Why would you sell at support? Here, if there's a falling window, a gap, and the bullish engulfing pattern is near that falling window's resistance, why would you buy at a resistance area? Right? So that's what I mean. It's a lot of, just look at where it appears, and candles in context also really, really important. And you mentioned that, Theo, and I'll conclude with this for a few slides, and I'll then just feel free to ask more questions. The third leg of our trade triad is trade management. And this is what it's all about. Changing your mind about risk. All right. This is why I said stop, protective stops. All right.
Yeah.
So, and this is key. A candle signal, even if it confirms 100 other indicators, is not enough reason for a trade. Always take into account risk reward. I like 1 to 2 risk reward. Some traders don't mind 1 to 1. They're very confident. Some like 1 to 3. But we always have to look at the risk reward before the traders. And that's, that's what getting back to here. If you're selling it here, all right, your target is here. It's the first support area, right? And I would have a protective stop here. It's not a good risk reward. So, okay. All right. So, last couple of slides, and then I'll have a slide for more information, then ask questions. Okay, which is a better signal to sell? And when I made this, I made black real buys instead of red, and instead of green, it's white and all that, which is a better signal to sell. And as
that's a very tricky question, though, right?
What's that?
That's a very tricky question. Which is a better?
Wait, we have a few minutes. Why don't they type in the answer?
Okay.
Just say B for bearish and S for shooting star to save time.
Okay. So you can use the chat box and you type which one do you believe it's better.
Or if they have something, if they have another idea.
Come on, I would like to see some answers. B, left, B. Also, Kyla, Steve answered your question. 1 to 2 most of the times. B. Okay, so far everyone goes for bearish engulfing.
Okay. All right, and
as we said, it's a tricky one.
And the correct answer is I'll see you next week. All right.
Depends. Oh, someone says depends on context. David, depends on the context.
100% correct.
Okay.
He gets a star. Send him a gold. Again, send him a star.
Okay.
All right. So we're going to look at this in context. Here's the bearish engulfing pattern. And here's the shooting star. Now, which is a better signal to sell? Obviously.
Guys.
You remember the bearish engulfing pattern, you don't know until the end of the session.
Yep.
So you're selling it here. Your
Shooting
stop is,
star now.
Yeah.
Yeah. Everyone says shooting star.
Yeah. Okay.
Yes.
So, right. The
Okay.
risk, if you sell it here, your risk is here, and your target, your target might be different. Remember, I like looking at support and resistance. You may be looking at something else. You may be looking at a moving average as a potential target, and it may be all the way down here. So but based on what I do, I like looking at horizontal, because I'm not big on angle trend lines because they're so subjective, but everybody's looking at the same horizontal support and resistance. So that's why I like looking at it. So you sell it here, your target is here, and your stop is here. Is that a good risk reward? Obviously not. Here, you could sell it here. Your stop is here. My target might be down here, not the low here. My target would be over here, just the recent support area. Is that a good risk reward? And of course,
that's a lucrative risk reward.
Right.
So, Steve, if you allow me just for a minute, because
I'm
obviously some traders will listen this on the podcast, and just to make sure they understand what we do here, Steve just showed us a slide with a bearish engulfing, strong reversal pattern right on resistance, and a shooting star, again strong reversal pattern from resistance. But the shooting star length from high to low, it's, for example, it's much less than the bearish engulfing, and it makes more lucrative reward to risk trade the shooting star. So that's all from this discussion.
Right. Yeah. So if you're looking at candles in isolation, which that's why I wanted to show you this, you would think this is more negative, right? The
yes, of course.
Really took control from the bears here. Okay, a little bit negative, but when you put it in the context of the market condition, risk reward. So the three items were candlesticks combining with Western technicals, and then risk reward.
Great.
Can I put this on, or I should do that later?
Yes, of course. So
I'll just leave that on. You can ask questions. And if there's any slides you want me to refer back to, I probably could find them on my slide deck if there's any.
All right. Now, can we just answer some questions, maybe? Guys, please, let's use the final 10 minutes we have to ask them some questions. So one question, can we go back to the previous, I think try some slides, because I don't remember which one.
What was it up?
Not this one, sorry. The support resistance, I will see it. I'll let yes, this one here.
Okay.
So someone asked, how far do you go back in history to identify support resistance and say, okay, this confirms resistance? Do you zoom out, let's say, for a year, for a week, or to the recent support or the recent resistance, and you take that as the current, as the more valid, let's say?
With this chart here, I would go back as far as necessary. The issue is when the markets make new highs, you don't have resistance. I have to.
Maybe that's not the best slide. Maybe we can find something else if that makes it.
Well, I would go back as far. So I would go back I would go to a weekly chart. This is a daily chart.
Yep.
I'd go to the weekly chart to find a resistance area. This is a new high for this move, but this was only I don't know what.
Let's take this double bottom example, for example.
Okay.
So I wouldn't say it's a bullish and the bullish engulfing on the left. That not left. left, that one there.
Yeah, it is not bullish because it has to be
Yes.
red. This has to be red, right?
Exactly. So would we take the low of that candle as support? And when we see the doji there or the hammer, that one there, we say we confirm a support zone. Can we say that?
Oh yeah, sure. Yeah, definitely. Yeah, I thought you were asking like up here on the daily chart, where's the next resistance area?
No.
No, I got you. Yeah. Oh, definitely. Yep. And that'd be a little higher risk trade. I'm more comfortable with the bullish engulfing pattern because the bulls are taking over. But what's nice about this is you have that long lower shadow confirming a support area. And so, right.
Awesome. Another question and that's my question. Okay. In your book, you mention about to be like Japanese, they trade like market chameleons, and you have to be a
market
chameleon.
Yeah, they adapt. Right.
What does it mean for traders? How can they be market chameleon?
All right. So adapting to the market. So let's look at this. Remember I said with this bearish engulfing pattern, my market would be here. And remember I said with the shooting star, my target wouldn't be here. My target would be here. Why? Because the market had changed since then. See how this now became this support area wasn't there, right?
Exactly.
So, chameleon, you're adapting to what the market has done since you did the trade. So because this is 3 out of 4 sessions held support right around whatever the market this is, 41.5. I still talking fractions, 41.5. Now, because I have to adapt, I've become a chameleon, adapt. If I sell here, my target is not here. My target is here. Because the market has changed, just like a chameleon adapts to the environment. So as the market environment changes, we need to adapt.
Yes, also. We have a question here. Kindly please, what are good continuation candlestick patterns with a trend? Continuation patterns with a trend. And do we buy when, let's say, we have an uptrend, price is rising? Do we buy, or do you prefer to wait for some kind of correction?
Right. So one of my favorite, I like buying breakouts. And the reason is, like I said, the change, let me see if I, could go back here again here. So I like buying breakouts, especially on a tall green candle. So let's mentally expand this line here. All right.
Yep.
I'd be buying it here. And I would have the old resistance, new support as my stop level. Okay. Maybe I'd give it a little bit more. I like buying breakouts. The problem is they're a little bit more esoteric. There's a rising three methods and all that with the Japanese candlesticks. Unfortunately, during an uptrend, by the time you get the signal, the market has rallied a lot. And very often you might be near a resistance area. So I like candles for bottom and top reversals, like a little bullish engulfing pattern here, confirming a hammer, a bullish engulfing pattern here. You don't always get these reversals. So
yes,
one on top of the other. And of course, they don't always work. That's why stops are about. But I prefer trading breakouts.
Cool. Thank you.
Okay. Assuming you have a good risk reward.
Yes, of course. So let me scroll for other questions. Guys, please use this few minutes left for your questions. What signals does the outside bars provide? What signals does the outside bars provide?
I'm not sure what they mean, but I'm thinking, let me go back here. I'm thinking the shadows. I don't know what that, he or she may be referring to the shadows. If that's the case, you could use use the shadows to see if the market's rejecting higher or lower prices, like a shooting star. I don't have it here, but a shooting star has a long upper shadow, so it's rejecting higher prices. So I'm not exactly sure what they mean by that.
Yes. Okay. I hope we answered the question. What about multi-time frame, different signals? Does
Well, I use
volume
that.
help the
I'm
message
not,
of candles?
I'm sorry, say it again.
I believe they are asking about multiple time frame. Maybe because it's not very clear. Maybe they refer to, I have, let's say, a bullish engulfing on support on the daily chart, and I want to go down to 16 minutes or 30 minutes time frame to find some small range candle to take advantage with the momentum.
Right.
That's what I can understand at least. Maybe volume can help there, they ask.
Maybe, yeah. I don't use.
Do you use volume in your trading?
No.
Because the candlestick, it show
Some-
us based on the size, right?
Size, yeah. Sometimes what I'll do if I want a little extra confirmation, I don't do this often. I'll look at the volume. Let's say it's a bullish engulfing pattern, and or let's say there's a bullish engulfing pattern. I'll see if there's lighter volume on the red real body and higher volume on the green real body. So,
Yep.
right. But not normally. I don't, because this is really showing you who's in charge, the bulls or the bears at that time. So.
Exactly.
Right.
But I really like, as we are in this slide, and I'm sure many traders they're going to have an aha moment now, because you said one of the most common mistakes traders do, they see bullish engulfing, but they don't pay attention if this bullish engulfing is coming after a series maybe of red candles coming after a downtrend, or it just appear in an uptrend. So
right.
It's a reversal signal. So we need to have a prior trend to have a reversal.
Right.
Yep.
Yeah.
Okay. What are the most frequent mistakes? What are the most frequent mistakes? I think Steve mentioned the mistakes. Yeah, most frequent mistakes. Do you want to recap? Like,
no, watch the video again. 90% of this on mistakes people make with candles. So I'm not going to, risk reward, obviously the trend, adding Western technicals, candles in context, meaning that look at where it is the market condition. So, but essentially the whole session was about using them correctly.
Yeah. Okay. So I would like at this stage, guys, to make sure that first to double check, did you take the link of Steve's website? I will send it again. I already put it on the chat box below, Steve.
Appreciate it. Yeah, we're going to offer a free consultation. So, and the Frontline Forex is kind of, if you think this was a lot of information, the Frontline Forex really has a lot more, puts it all together and focuses exclusively on Forex. There are some nuances I didn't have time to get into today between candles and Forex, because the opening and closing are almost always the same in Forex, except for Mondays.
Yes.
And you look at the candlestick signals a little differently in Forex. So I didn't have time to go through that. So if you're trading mostly Forex, I would suggest looking at the Frontline Forex. But, go to this link here, get a free consultation and find out which is the best product for you.
Perfect. So guys, you can just directly click on the link I put on the chat box and it can take you to the website. That's great. I think we will answer the last question, okay, because we have a couple of more minutes. What's the best way? What is the best combination, technical indicator plus candle pattern? What is the best combination of a technical indicator and a candlestick pattern? That's what I understand.
I keep it simple. Like I mentioned before, I just love looking horizontal support resistance. But if you find stochastics or Fibonacci retracements work really well in your market, you'll probably know, especially if you trade intraday, more about the nuances of your particular Forex or cross, whatever it is. You'll know which Western indicators work best. Stay with that, and then add the correct way to use candles to that Western indicator.
So we don't flip because we have maybe a losing trade using a stochastic oscillator, and we're going to go to the commodity channel index or to the Bollinger Band. We have a winning trade, and then we get excited, and then we go back and forth, and because that messed a lot of traders' accounts, right?
I suggest keeping a trading diary also if you don't do that. You know,
okay, guys, you listen that?
Yeah.
So at this point, I think we came to the end of this very informative webinar. Again, it was a privilege and honor from myself and the whole Admirals to have you here, Steve, live with us. Undoubtedly, you add a lot of value to those who watch it live, and also those who are going to watch it on the YouTube when we're going to upload it, and of course on the podcast. And it was something incredible, and we would like to thank you so much for your time.
Okay, my pleasure, and thank you for inviting me.
Thank you so much. Traders, ladies and gentlemen, wherever you are in the world, myself and Admirals would like to thank you so much for your participation, and we wish you all the best with your trading, and looking forward to see you on our next market talk, and also on the live trading we do every day. Thank you so much, and good night to everyone.